Hey guys, welcome back to our channel where we break down tax strategies so that everyone can use them. You are probably watching this video because you own real estate investment property and you live in California, and you are trying to understand the nuances of running a 1031 exchange in California. A 1031 exchange is a tax deferral strategy that allows real estate investors to sell one property and exchange it for a new property while deferring capital gains. It is a federal rule. It is an IRS code section 1031, and it applies to the entire country. And if you live in California, the same rules apply. There just are some nuances. But let's start with the basic rules. Rule number one, it must be an investment property. So the property being exchanged must be like-kind real estate investments. Rule number two, when you are exchanging those properties, the new property must be of equal value or greater value, but cannot exceed 200% of the initial value of the sale in order for you to completely defer those capital gains. Rule number three, the person selling the initial property must be the same person that is buying the new property in an exchange. It must be in the same individual's name for the exchange to qualify. Rule number four, and it is very important, there is a strict timeline. You must identify the new property within 45 days of the closing of the initial property. Then you have a total of 180 days to finish and complete the sale. This is very strict. You cannot be one day over on either the 45-day rule or the total 180 days. And rule number five, that is the same in all the states, is that you must have a third party. It's called a qualified intermediary. Hold the proceeds during the exchange process. You cannot access that capital during the exchange. The third party will exchange those proceeds for you. Now here is where things get interesting if you live in California. There's something in California called the California clawback provision. If you previously owned a property in California and now you are exchanging for a property in another state, there may be some provisions that wouldn't apply if those two properties were outside of California. When you exchange a property from inside California to a property outside California, there is a catch. California may require you to pay capital gains on the appreciation of the initial property that was in California, even if it's going through a 1031 exchange. If you are selling a property in California and you are going through a 1031 exchange, you will likely want to work with a qualified intermediary or an accountant that's familiar with the California provisions. As most of us know that live in the sunny state, California is one of the most strict when it comes to tax rules. If you are running a 1031 exchange outside of California, this clawback rule will not apply.